In this video, we're looking at Mars Protocol. This is a fully on-chain, community-governed, non-custodial bank. And I think this is going to be a huge piece of the puzzle for the overall Terra ecosystem and a real core primitive that will add a ton of value and TVL. Now, this token is not currently trading, but we have an opportunity to get involved with it before it hits the open market through something called a Lockdrop. So we will go through what this protocol is all about, how it operates, and then how to participate in the Lockdrop. So if you're keen for that kind of information, then make sure you subscribe to the channel, turn on the post notifications by dinging the bell, and for further support, check out my Patreon link down below. So Mars Protocol is coming very soon. There is no current token, nor Telegram or Discord groups. If you find any of these, they will be a scam. Now, these guys gave us a hint here with the lock and the drop symbol, and then just came out and said it. Lockdrop coming soon for this one. An excellent way to not actually spend much apart from an opportunity cost, and then get some tokens for free at the ground level before this one blows up. So here we have the Mars Protocol Light Paper 1.0. So as I mentioned, this is a fully on-chain, non-custodial, open source, transparent, and algorithmic in execution and community governed bank of the future. And like all banks, they try to attract depositors and then lend out their money, at the same time managing illiquidity and insolvency risk. But this will all be governed by the Martian Council, and to become part of the Martian Council, you need to be a Mars staker. So you really put skin in the game with this and underwrite some of the protocol risk. We'll go into the risks of actually staking on Mars during this video, but it also gives you value accrual. So you put skin in the game, you risk something. However, on the flip side, you're also going to get a share of protocol borrowing fees as well, which could be highly lucrative. And this is incubated by the Gigabrain over at Delphi Labs. These guys have helped incubate many projects and have designed tokenomics for the likes of Axie Infinity and have worked closely with Synthetics and also Aave. So a very stellar team running this one. So one of the key differentiators here is in existing money markets, interest rates are priced algorithmically based on utilization rates. But unlike existing money markets, Mars utilizes a dynamic interest rate model based on control theory. So they have their own algorithm that is responsive, which improves the overall capital efficiency of this protocol. So you can think of this one as a mixture of the likes of Aave that you probably already have heard of, but it also mixes in leveraged yield farming similar to the likes on Alpha Homura. So just like Aave, you can take out a collateralized debt position. So me or you will be on the business to consumer side here. If you want to take out a loan, you have to post up some assets as collateral. But on the flip side, another unique selling point here is the fact they have uncollateralized debt that can be issued to whitelisted smart contracts. So as far as I'm aware, no other protocol currently offers this, and this is a very big reason that I'm highly interested in this. It makes the addressable market for Mars absolutely massive. So why would you want to have this uncollateralized lending? Well, it says these will involve simple leverage yield farming strategies on Mirror and Nebula that specific whitelisted smart contracts can get credit for. So another company in the industry may want to take advantage of these yield farms. Maybe they've got a load of a certain token. Maybe it's a Mirror and UST liquidity pool. They've already got a ton of Mirror, but they haven't got the UST. They don't want to sell off half their Mirror to get involved with this. They can come to Mars, get whitelisted. Mars will check out the smart contracts to make sure the logic makes sense, and then post up the UST so they can take full advantage of that opportunity. And then, of course, they will pay a borrow fee for getting that uncollateralized loan. So very important stuff here. And then these are the following stakeholders. Of course, we have lenders. These are the individuals depositing their assets into the liquidity pools, and of course they earn an interest rate for doing this. We then have the collateralized borrowers. So like me and you, we can borrow assets from the liquidity pools, but we have to deposit our assets as collateral. And of course, this can make us a lender on the flip side there. And then on the borrower uncollateralized side, these are the smart contracts borrowing assets from the liquidity pools without posting the collateral. But each of these smart contracts will be offered and extended a credit line dependent on the approval of governance. And of course, there will be thorough checks to ensure there's not too much protocol risk there. So not any normal Joe Blogs taking out uncollateralized loans. There will be a vetting process. And then finally, we have the Mars Council made made up of Mars stakers. These guys can earn protocol fees, participate in the governance, and underwrite the protocol risks. So we have a little layout here of what happens. If you're a Mars holder, you can stake your Mars and in return get X Mars. This will accrue value as follows. We have the users coming to the platform, depositing their assets and taking out loans. This in turn earns a fee coming back to the council here. And then on the top side here, we have the uncollateralized borrowing from the smart contracts. And again, these guys get the credit and of course they pay back a fee for this. Again, that comes back to the Martian Council and thus to the Mars stakers. So on the borrow side here, of course, we know people have to deposit their assets into these money markets, and then in return, they will receive an interest-bearing token. So these will be called MA tokens here, similar to the fact you have like Aave-based tokens like A-Link, for example, and these will represent your share of the liquidity pool. By depositing your asset, you can then take out a loan, and this lending serves two purposes, generating yield, and if the user chooses, acts as collateral to borrow against. And with any of these things, you have to take into account LTV. If your loan-to-value ratio falls below the maintenance, a margin call is placed, and your assets can be liquidated to pay back the loaned amount. At the launch process, they're going to accept Anchor, UST, Mirror, and Luna for borrow and lend. But as this is going to be community run through governance, there will be a proposal process by which other assets can be added, and they'll be able to support any CW20 based tokens, the tokens native to Terra. There's a few examples here of how this works with the LTV ratios and the liquidation conditions. So go and check those out to understand further how the money market works, but pretty straightforward stuff, to be honest with you. And then we come on to the uncollateralized borrowing side of things. And this is where leverage yield farming strategies come into play here. So traditional money markets products offer relatively low interest rates. And this is because there's capital inefficiency. They have to be highly over-collateralized with low LTVs. But uncollateralized loans solve a major problem, a low addressable market and capital inefficiency. So this allows Mars to tap into a completely new source of borrowing demand. You can imagine many different protocols will want to tap into this, especially across the Terra ecosystem. And this means they will be able to generate higher borrower demand, better utilization rates, and therefore higher yields for the Mars lenders. And overall for the Terra ecosystem, this will boost TVL, I'm sure. And the first project that will be able to tap into this will be Mars itself. And this will give access to leveraged yield farming strategies for the following: Mirror UST and Anchor UST. So in the background, the protocol will lever up these two strategies, giving you, I think, about a 2x leverage position. They show the full workings of that down here, but these strategies themselves are collateralized, and Mars simply needs to trust the smart contract and liquidation logic in order to safely extend this credit. So the collateralized side of borrowing, similar to Aave, and the uncollateralized leveraged yield farming strategies here, similar to that of Alpha Homora, both of which these projects have a very high market cap. So I think this protocol will be stepping into the arena with its sights set on some big competition here. And so I think this project has a lot of upside and a big market cap to aim for. In this light paper, they also go over the liquidation processes, how anyone can actually repay a fraction of a borrower's debt if they get liquidated. And then the liquidators can choose to either receive the liquidity tokens or receive the underlying assets. And the similar side here for the uncollateralized borrowing, where liquidators can step in and take some of these assets away and thus repay any protocol-based debts here. So they got all bases covered, full explanations and diagrams of how this all works within here if you want to go and check those out. But next up, let's have a look at the dynamic interest rates that they've got going on, which makes them, again, a unique selling point. So they cite compound here, and a typical interest rate will have a slope similar to this. So they cite the issue here that in this model, a curve is fixed, cannot react to external market conditions, and thus, if there's a particularly good stablecoin farm 1 week paying, say, 500% APR, then even at a 90% interest rate corresponding to 100% utilization on most money markets, borrowers will be unwilling to pay back their debts, and depositors will be unwilling to supply more assets into the pool, which is highly inefficient. So the Mars solution here, instead of a curve, is to use control theory to allow interest rates to adapt dynamically to market conditions in real time. So this can adapt on a block by block ratio to increase interest rates, which would help force the optimal utilization ratio, because if it keeps ticking up and up and up, there's going to be a point at which people will no longer want to borrow if utilization was low, they can just keep bumping up the rate until people do step in and start supplying assets. So here we have the token economics of Mars, and they are quite important to understand. This essentially uses game theory to align the incentives of those making decisions with the health of the protocol. So it says the guiding principle behind Mars token economics is that of skin in the game. Those making decisions should bear the consequences of those decisions, both positively and negatively. So if you stake Mars, you get X Mars. So if you wish to hold the Mars token and you want to participate in governance, you need to stake it, and you will get X Mars in return. There is a 2-week unstaking period. So 1 X Mars is 1 unit of voting power. So things like the listing of new assets, risk parameters, treasury spend, that kind of thing is things you can vote upon. The fees here, so X Mars, similar to that of X Sushi, is a value accrual token. You get a share of protocol interest rates revenues. This happens as those revenues are used to buy Mars on the open market and add it to the X Mars pool. And this will also initially be an incentivized pool as well. So I think it could be very lucrative to get with this from the get-go. Insurance wise, you are the backstop here. So these X Mars holders insure the protocol risk. Up to 30% of their stake being locked could be sold in the event of a shortfall. So if we have a shortfall event here and it gets triggered, the insurance fund and X Mars staking pool are both frozen to prevent withdrawals. So in this instance, we first go to the insurance fund here, and this will act as the first line of defense, and this will be made up of AUST. This would then be converted to UST to make whole the affected users. But if this is not enough, we then move to Martian Council and those stakers, and these guys then have to make those affected by the shortfall whole here. So it says up to 50% of the Mars staking here will be auctioned off to repay those who are affected. And still, if this was not enough at that point, it will then go to a governance vote onto what to do next. But it's important to understand the risks you're taking on by actually staking Mars. But this does really align the incentives of those governing the protocol to ensure that the protocol acts in the best interest of everyone. You wouldn't want to make silly decisions like listing high risk assets when you know your money's on the line. So the value accrual is as follows. 80% of all interest payments go to the lenders. But then on the flip side, 20% is then split amongst the Mars Treasury, the insurance fund, and the X Mars stakers. So this is how we get that value accrual. Borrowers' interest payments, 80% for the depositor, and then the 20% split between these 3 functions down here. And if we can attract significant TVL, say in the billions, the overall interest payments could be absolutely huge, and this could mean significant value accrual to the stakers down here. And of course, this needs to be lucrative. When you're taking on risk, you expect a reward in return. In terms of that token distribution here, we have an initial airdrop of 5%. Now, this is made up of 2.5% for the Lockdrop participants, and I believe 2.5% to Luna stakers. Investors in the project get 10% of the tokens, team and advisors 20%, there's a 10% Mars reserve, and the rest will be for community incentives. In terms of team, advisors, and investors, these guys are all subject to a 6-month cliff, and then a linear vesting period, 3 years for team and advisors, and 1 year for those investors. So I think overall the distribution looks pretty good. In conclusion, they talk about how the burgeoning DeFi ecosystem on Terra is very attractive, and they see themselves filling the position here of a core primitive as an efficient money market to service this overall ecosystem. So they're very bullish on Terra, and they believe this will be a key piece of infrastructure. So here we have the notification of the Lockdrop. So this is how we're going to be able to participate and get some of these tokens essentially for free. What you have to do is actually lock up some UST. So you will need UST on hand for this one, and then you can participate. So as follows, it says, to bootstrap the supply side of the Terra USD credit pool, a lock drop will be organized before the launch of the Mars protocol. During a 14-day window deemed the ignition phase, users can lock and deposit UST at Mars protocol for a fixed duration, anywhere from between 1 to 52 weeks. You can deposit multiple times. You could do some with no lock, you could do some with a long lock or a short lock. It's totally up to you with how you go about doing this. Maybe have a little think about how you can gamify this. When do you think would be the best duration to lock for? There's of course going to be a weighting to this. The longer you lock, the more Mars you're going to receive. And by locking in, you actually receive the X Mars token. You can participate with this by just putting down UST and not locking, but you will only get the Mars token. During the first 12 of the 14 days, you can actually withdraw. So you could perform a U-turn, decide it's not for you, but between days 12 and 14, there are no withdrawals possible. And this is to try and stop any whale games early on. And then after day 14, we'll get our Mars distributed to participants. So the Mars distributed will be calculated on a weighted pro rata basis against each lock drop position, and Mars tokens will become claimable by lock drop participants. They've got the weighting and how that is calculated. Each lock drop depositor will be able to claim Mars tokens. The lock drop depositors will become the red bank lenders then, as these UST can then be borrowed by Mars users through the red bank, which is the name of this. In addition to the Mars claimable immediately due to participation in the lock drops, as lenders, the lock drop depositors, like all other red bank lenders, also receive X Mars, which will accrue per block over their UST deposit in the red bank. And as you're lending to the protocol, you're also going to get an interest on this locked UST. So it will get some yield accruing to it, as you're going to be getting the MA, so the Mars UST tokens. And at the end of the lock period, you can then convert your MA UST into UST. And so at that point, you get the interest payments. There's quite a lot of disclaimers within this lock drop proposal. And I mean a lot. If you scroll down, there's pages and pages of pages of all of these various disclaimers and warnings down here. Essentially, they're trying to build a fully decentralized protocol that is not governed by any single individual. This also ensures that governments and agents of the government can't go after anyone specifically, and they do want this to just run itself over time, similar to the ethos of Terraform Labs, who do plan to just disappear at some stage. So lock drop participants will get 2.5% or 2,500,000 Mars tokens. And the two key factors to be aware of here concerning how many tokens you'll get will be the length of the lockup that you actually go for. So the longer, the more you're going to get, and the total amount of UST deposited during the ignition phase. So it's going to be pro rata. The more money you put in, the more you're going to get back. So 2.5% to lock drop participants, and then 2.5% to lunar stakers via airdrops. As you can see, Mars is listed here on lunarairdrops.com. And so if you're staking Luna already and you're going to participate in this, you can get a good chunk of these Mars tokens. And I'm bullish on this one because the TVL on Terra is looking very healthy. And over the last 10 days, we had Apollo DAO join the network, and they already attracted $150 million in TVL. So I think this is super bullish for Mars, and I think the TVL growth rate will be rather astounding. And this will also be tapped in by other protocols on the Terra ecosystem. They're all going to want to get involved with that uncollateralized lending. And as a prospective Mars holder myself, the more TVL, the more usage of this protocol will mean more protocol fees as a staker, and I plan to stake my Mars for X Mars. So I think this is a great looking project. I expect this one to have a market cap in the hundreds of millions in the short to medium term, and then billions over the long run. This is really trying to put the cat amongst the pigeons, become the Aave, become the Alpha Homora of this ecosystem. And as we know, with the integration of Wormhole and IBC after Columbus 5, Terra will be fully multi-chain, and so can attract assets from all these different blockchains. And I'm sure they will want to tap into Mars protocol with its unique selling points. So that's my rundown of this one. I hope you enjoyed it. I hope you got some value from that. If you did, make sure you subscribe to the channel. I will be participating with this lock drop. If you'd like to see me do a video on that process, drop me a comment down below and I'll be happy to get that done. But until next time, folks, goodbye.